What's up, everyone? We're back with the DeFi Podcast, episode number 2. I'm joined again by David Foley, CEO of DeFi Strategies. Lots of action in the crypto world since we last broadcasted. SundaeSwap Reverse ISO, Monero 51% attack, $2 million Ethereum network hack just last week. So what do you want to start with, David? Do you want to talk a little bit about the SundaeSwap Reverse ISO initially and kind of get our thoughts on that?
Yeah, so basically the SundaeSwap Reverse ISO is something the Sunday team is doing to help decentralize the Cardano network. Mm-hmm. So they're doing this because they feel that over the last 5 to 6 weeks that they've played a part in the network centralizing of it. And so the way that you can measure network decentralization is through something called a Nakamoto coefficient. And so what this means is how many groups that you'd have to take over in order to 51% attack a certain network. So in this case, once the SundaeSwap ISO started, the Nakamoto coefficient went from 25 to 22. So Sunday feels they have some level of responsibility in this, and so they're trying to get delegators that moved into the 30 pools that they had for their launch, the token launch. They are trying to get people to move out to the pools that were nominated for becoming Sunday pools, but were not. So they're trying to get people to migrate from these 30 pools that the Sunday ISO is in to about 200 to 300 pools that were nominated instead. So they're trying to do something to mitigate some or all of this decentralization, or sorry, centralization that they caused. So I'm interested to see what the effect will be on if this is success, like kind of the degree of success that this has, and maybe, I don't know, I'm curious to see how other launches take this into account. And when I say this, I mean kind of the SundaeSwap release. So how can maybe other tokens release in a way that doesn't centralize the network in the same way that this has? So kind of using this as a learning experience for future launches, because this was kind of the first big launch on Cardano, at least in my opinion.
Well, the good thing that I saw kind of a trend from before the SundaeSwap ISO and after is that we saw the market share of single pool operators go up. So we saw some people migrating from the multi-poolers, from Binance, from ADA Lite to the single pool operators. I think the percentages went from like 17% of the active stake being with SPOs to over now 20% of the active stake being with SPOs. Now what they're trying to do is take the centralization happening within the SPO community because of the ISO and sort of reverse that and start getting some of these other SPOs involved in what they're doing. So I think it's a really positive thing that Sunday's doing overall, and I'm happy that they're making an effort to correct that the discrepancy, or not discrepancy, but what happened with the Nakamoto coefficient going down. So speaking of tokens, let's talk a little bit about our token. We're not on the SundaeSwap ISO. We're not in the reverse ISO either. We're a pretty new pool, but we're growing pretty rapidly. We have over 130,000 Cardano actively pledged with our pool, with, I believe we just cracked 216K active stake in the pool. We just hit our second block, and we are launching our own initial stake pool, offering our own governance token. So I want to ask you about that, David. What are your hopes with the token? Tell us a little bit about what we're doing.
So basically we have this token for our stake pool, and we kind of saw an opportunity to open up management of the stake pool to a broader audience than just ourselves. And so our philosophy is that we can pool knowledge from our delegators and ourselves to basically create a better pool. So rather than just relying on the core team to manage the pool and kind of innovate in whatever way that we can, we want to also take feedback from our delegators and make sure that they have a say in how the pool is managed. So we're trying to align the operator's incentives with the delegators' incentives more than we feel the protocol does already. So there are a lot of pools out there that charge high fees, which we feel is a misalignment of operator and delegator incentives. And so it's obviously in the operator's best interest to have a higher margin, and it's obviously in the delegator's less interest to have a lower margin so that they keep more of their rewards. So our token is trying to impart, well, this is kind of one example, but our token is a way that operators and delegators can communicate by basically using these governance pledge requirements.
Sorry, David, you cut out there for just a second. You were saying to use these governance tokens to what?
Oh, to use these governance tokens as a way to find an equilibrium between delegator and operator interests, so that we can find kind of a level between what the operator or us, what we think is best, and what the delegator thinks is best.
Now I want to ask you, and I know about this too, but the method of disbursement, how are we getting these tokens to delegators? Are we using drip drops, or are we doing something a little bit different?
So initially we had considered drip drops, but after some further investigation and some feedback from the community, we kind of felt that their fees were kind of high. So it's maybe 1.7 ADA to claim a single token, and I think it's like 1.9 to claim up to 10. So let's just call it 1 ADA to claim these tokens. We felt that 1 ADA per epoch to claim these tokens was too high.
And there's a time constraint too.
Yeah, so basically on drip drops, if you don't claim your tokens within a 5-day period, they're kind of gone forever.
Mm-hmm.
So we wanted to make sure that no matter what, delegators had access to all of their governance tokens, and essentially they could claim them at any time without like fear of losing these tokens. So there's a couple things that we're doing. So we've spoken with a couple smart contract developers in the Cardano space. So we're trying to create our own distribution mechanism that would be much cheaper than something like drip drops. Like, we don't intend to charge a fee. We're just trying to use it to distribute our tokens. So whatever the fees, if any, would just be the network fee.
Mm-hmm. The minimum transaction fee.
Yeah. So like 0.17 Cardano, maybe something around there.
So we're effectively trying to cut out drip drops as a middleman. Nothing against drip drops. They have a cool thing going for them, but we don't want our delegators to have a time constraint around collecting their tokens, nor do we want them to have to pay an additional fee to collect the tokens that they've earned through staking to our pool. So I think those are some really important points. Can you talk to us a little bit about the minting policy of our token? I know we have something, and we've talked personally about the quadratic voting system and how that works. So tell us a little bit about the minting policy and the purpose of quadratic voting.
So initially, we're going to manually be minting the tokens, probably batches of maybe 10 million or so. Actually, delegators will be able to mint the tokens by interacting with a DAO or maybe a smart contract that automates this process. So delegators will be able to see how many unclaimed tokens there are in the entire system, how many tokens there are circulating, kind of basically we're trying to give delegators a way to see like active and dormant governance tokens, kind of in the same way that people talk about like active and dormant Bitcoins, like
Mhm.
Bitcoin addresses that haven't moved in X number of days or whatever. But this kind of gives some insights and metrics into participation levels within our community, and kind of giving people an idea of how much weight their votes hold. So as we progress, it'll become more and more automated and more like a DAO, and we'll be able to slowly transition from a state where the three of us can operate the stake pool to where we can find some kind of like hybrid management scenario. Like I would imagine that we would still have the hardware.
Mhm.
Maybe, well, okay, I would imagine we would at least have a block producer. We could potentially look at maybe moving relays to delegators that are maybe in specific prime locations geographically.
Well, we'll have to see about that. Having a relay with delegators might pose some sort of security concern if they know what port is open for our block producer. So we don't want, it would have to be a trustworthy actor on that end. So we'll have to really give some thought to that. But I think it's really important what you're saying about where we are with the token now versus what our goals with it are to eventually DAOify and kind of give the pool or as much of the pool infrastructure up to automation. So right now we are manually tracking each delegator wallet. It does pull we have a script pulling each stake address that is delegated to our pool on a daily basis to figure out how much Cardano was delegated to our pool and for how long. And we are actively keeping track of how many governance tokens each of our delegators has accumulated. And when they want to cash out, they send it to us and we track the transaction manually and then manually disperse the governance tokens to each delegator. But what we're trying to do is to automate both a dashboard for delegators to examine, to figure out like something really clean cut that can tell delegators how many tokens they've accumulated, how much each token is worth in Cardano. But also in addition to that dashboard, and most importantly, we're looking for an automated script, some type of method to intake Cardano, calculate the minimum transaction fee, spit that Cardano back to each delegator with their governance token on top of that automatically. So I'm working out with some stuff in the test net. We're speaking with some developers, as you mentioned, to try to get this done. And it is going to be a long process. There's going to be a lot of problems we need to troubleshoot. But I'm confident that we will be able to do it at the end of the day with enough time and energy. So let me see here. We wanted to also talk. Oh, go ahead.
Something else I wanted to mention. It's important that delegators are also aware of not necessarily our constraints, but also the level of advancement in the Cardano smart contract space. So Ethereum has had smart contracts out for 4+5 years or more, maybe. So there's a lot of tools and resources out there to get started quickly and pretty easily. But since Cardano's smart contract space is younger, those same resources may not be available. So it's important that delegators are aware of the differences between the two ecosystems and kind of keep in mind that although the progress might be slower, it's not necessarily, some of it might be a reflection of our experience in this space, but some of it is also due to Cardano's like newness. Like the smart contracts have only been around for maybe 4 months, so the same like development tools and resources that are available are at most like just that old.
Right. Well, Shelley didn't happen until July of 2020, which introduced stake pools. So stake pools are under 2 years old in general, and then the smart contracts were only a few months ago, as you mentioned. So in terms of catching up with Ethereum, yes, I think we'll get there in terms of like market capitalization and how large the network is. I think we're on Ethereum's heels, so to speak, but there is some catching up to do still. So I wanted to kind of shift gears a little bit from Cardano and talk about the Monero 51% attack. Talk to us a little bit about how this happened, what happened, and where we go from here in terms of like how we approach the Monero blockchain.
So there wasn't actually a 51% attack on the Monero chain. There was a mining pool that, the mining pool I believe was minexmr.com, I think was the mining pool. So that mining pool had 52% of the network hash rate for some period of time, at most, maybe a few hours. I don't remember exactly. Chains that can be or have been 51% attacked is that, so the fear of a 51% attack is that it would allow somebody to double spend their currency, meaning I could use the same Bitcoin, Ethereum, Monero to buy two different things with the same currency, and basically neither party would know that I basically didn't have these funds. So the issue with Monero specifically is that since it's anonymous, detecting double spend attacks can be much more difficult because the blockchain is private or encrypted. And if you go and look at a Monero transaction explorer, pretty much all you can see is the fee and the size of the transaction. Like, you don't have the same information that maybe a Bitcoin, Ethereum, or Cardano transaction would show you in terms of, like, even the amount sent, like, is not visible. So catching a double spend when you don't have any information like that can be much harder. And so that was kind of the concern. So basically, to mitigate this, what people have been doing is turning on old PCs that they've had laying around to get hash power into other pools, or they've been renting out hash power on Nicehash or something to get hash power into other pools. But well, I mean, to even get to the point where we're at this phase is, like, you should be thinking about this when a pool gets to like 33% or more. Like, just because you can't attack at 33 doesn't mean that if a pool controls a third of the hash power, that things are fine. It would be no different than if Binance controlled a third of all the Cardano pools. Like, that wouldn't be fine either. But even though they can't necessarily attack independently, that's a big chunk.
Well, it's similar to what was happening on Ravencoin, where they didn't actually get 51% attacked, but these pools are getting dangerously close. And I think that even if they don't act on that, even if the pools aren't malicious actors and they don't attack the network, just the fact that there are mining pools consolidating this much hash rate poses a security concern for the blockchain enough that it can actually affect the growth or the long-term growth of that chain. So, I mean, what exchange is going to want exposure to a coin, or a large investor is going to want exposure to a coin when it still has the threat of a double spend or a 51% attack? What large project developers are going to want to develop off a blockchain that has these security concerns? So I think it's really important that, you know, the communities of these cryptocurrencies, of these blockchains, both in Monero's case and in Ravencoin's case, that not only can we look and see these posts on the forums that say, oh, two miners is getting too close to a 51% attack, switch pools. I don't think that's good enough. I think there needs to be some sort of financial incentive for good behavior on chain. I think, like in Cardano's case, with all the single pool operators, the Cardano Foundation heavily incentivizes single pool operation, both with the saturation curve, the IOHK delegation. There's many different ways. I mean, SundaeSwap even. There's many different ways that that the foundation is encouraging single pool operation financially. And I'm not sure if that, I know that's not happening on Ravencoin, and I don't think much of that financial incentive is happening on Monero either. So with that being said, let's shift gears off of Monero, unless you had any final thoughts on that.
Yeah, what was I going to say? I don't know, there's an idea that Monero is like more decentralized or something because it's
The
CPU
privacy coin.
mining.
Hmm.
Well, that, and it's CPU mining, so it's like harder to mass mine, like it's harder to have mining farms, supposedly. I mean, I've tried mining Monero myself. It's like, good luck
Hmm.
mining properly. It's like
Right.
nearly impossible.
Well, I
So
think there may be some significance in the idea. So with the markets kind of having their recent connection or correction, excuse me, with the recent market correction and more people switching off their GPU miners, more people switching off their CPU miners, with the inflation causing electricity to rise, with mining being less profitable in general, there's more people switching off their miners, which is leading to the opportunity for these big like factory farms to consolidate hash rate with a single mining pool. So I don't think it's any coincidence that we're starting to see some more hash rate consolidation as these networks and as the global economy goes through some of these corrections that we've been seeing. Would you agree with that, David?
yeah, so what I wanted to say before was a 51% attack can create a pretty bad positive feedback loop where basically this pool has 51% or more of the hash rate. So then miners in the other pools leave because they feel that this pool that has 51% now basically dominates the chain. So if miners leave from the other side of from the 49%, it creates this feedback loop where the 51% attacking agent basically gets 67.
Sorry, David, you
For
cut out there. You said they get 67%.
so like basically it creates this positive feedback loop where it pushes a pool with 51% attack, 51% to like 60 or 70 or 100% of the hash rate of this network. Because if I'm in the 49% or I'm not in this pool, I don't really have a say in like consensus anymore. Like this, the pool with 51% of the network can basically mine blocks in private and then just release a longer chain the second that this other 49% has a longer chain. So they can basically mine blocks in private, not publish them, and then publish them once this minority chain thinks or claims it has a longer chain. So because of that scenario, actual honest miners end up leaving the network in hopes of finding some other more
A better one.
profitable, safer coin to mine. But it ends up like once you get to this 51%, it's basically a retreat to something that's not an attack, or it just kind of goes off into the deep end.
We've also seen a lot of miners, and I've been guilty of this personally when I first started out, but mining on Nicehash. So when you're on Nicehash, what they do is they can actually, like mining pools can rent hash rate from Nicehash. So that's what happened recently with two miners and Ravencoin, is they actually rented out additional hash rate from Nicehash and accumulated 47% of the network hash rate. So it's important that, I guess, as a miner, you keep in mind of your efforts with the blockchain. So you don't really want to be shooting yourself in the foot by mining off Nicehash, I guess, participating in a chain. What am I trying to say? So like if you're accumulating Ethereum,
Nicehash, you're like allowing someone to use you as a pawn in an attack without even like realizing it.
Exactly, and it can hurt the value of the cryptocurrency that you're mining and accumulating. So just as a miner, it's really important to be careful of those things, no matter how large or small you might be. So there's one other thing I want to ask you about Monero. So it was about the future of privacy coins in general. I know you see a lot of regulation, a lot of lawmaker crackdowns on privacy coins. A few months ago, the founder of Monero was arrested. I don't exactly remember what for, but with all these efforts to dissuade people against away from blockchain and privacy coins in particular, where do you see the future of these coins going? And do you think that there's a place for privacy coins in the future of blockchain?
Privacy coins, because there will always be minority groups or oppressed groups that don't have power in some situation. And so one of the downsides of blockchain technology is that for the most part, it's mostly public ledger. So it's public information, anybody can access it, including governments, adversaries, whoever can access it. So if there's some kind of oppressive regime, it can be absolutely imperative for somebody's safety and well-being that they have access to a privacy coin. I don't know, in my mind, I kind of think of like Monero as kind of being a currency that maybe would have been used on like the Underground Railroad in the United States, or maybe by Jews trying to seek safety in like Nazi Germany or something, some kind of dire scenario where if your financial transactions were public, it would be a threat to your physical safety. So, I mean, there are numerous examples where if everyone's financial data was publicly available, depending on the time in history that you're looking at, privacy is important, like crucial to, in some cases, maintaining your life. So I think, I mean, that's kind of an extreme example, but like there is absolutely a use case outside of like the purported claims that like who would use Monero other than like criminals. Well, there's numerous examples as to why you would. It's not even a matter of, it's just a matter of, it's not even the privacy per se, it's purely not wanting to be public about everything, I guess. So,
Do you prefer a privacy coin versus a traditional cryptocurrency? Would you say that there's advantages to either? I know that sometimes development on privacy coins can be a little bit difficult because of the way that they scramble the addresses, like wallet addresses and such. Could you talk to me, I guess, a little bit about the advantages and disadvantages that privacy coins have?
So see, I don't know, there's this interesting. So one of the core pillars of cryptocurrency is that cryptocurrencies are supposed to be fungible. So one Bitcoin should be indistinguishable from another Bitcoin, one Ethereum to one Ethereum, one Monero to one Monero. But the issue with like a Monero versus a Bitcoin in terms of fungibility is which Bitcoins I want to accept and not accept based on, I believe they call them like cassius coins or tainted coins or colored coins. These are like some of the terms they use for basically dirty Bitcoins that have been used in some kind of crime. I don't know who determines this. It's usually like blockchain analysis companies. But basically, people can pick and choose which Bitcoins they want to accept or not accept, basically if they're clean or not, which essentially breaks fungibility because one Bitcoin no longer equals one Bitcoin. So in a privacy coin like Monero, this doesn't exist. There is no way to distinguish one Monero from another Monero. So there is no concept of clean versus dirty, like Monero. One Monero is one Monero, and that's it. Like there's no confusion of like what's been tainted and what's not. Because like in the US, they used to like test money for coke or something, like cocaine, let's say, and they'd be like, "Oh, this dollar has trace amounts of cocaine."
It's
like
pretty money
or whatever. Yeah, but like they later found out that over time, all currency has trace amounts of cocaine on it. So my point is that what do you do when every Bitcoin now has trace amounts of criminal activity or whatever associated with it.
Mhm.
Like, what do you do? Because like basically, if you have these tainted or colored coin scenarios, eventually all of the coins become tainted or colored. So what do you do then when most of the coins in circulation just have trace amounts of whatever associated with it that's undesirable? So in that way, privacy coins have a leg up over other currencies because they meet the fungibility requirement that public chains can't.
Yeah, thank you. That makes sense. And with that all being said, I wanted to talk a little bit about some of the not only the similarities and differences between like privacy coins and traditional cryptocurrencies, but let's talk about some of the similarities and differences between what I have coined as the big three: Bitcoin, Ethereum, and Cardano. Though at least those are my big three. Now, these are commonly referred to as first, second, and third generation cryptocurrencies, Bitcoin being the first, Ethereum being the second generation, and ADA being the third. Sort of, you can see the chain where they're building off each other's code, and the network that was built on each. So I wondered if you could elaborate and talk a little bit to the audience about some of the differences between each of these cryptocurrencies and why they're significant.
Yeah, so Bitcoin was the first cryptocurrency. So it's the simplest and most straightforward in that I lost my train of thought. But yeah, Bitcoin is first. It's kind of straightforward in terms of there's a block every 10 minutes. There's a fixed supply. For the most part, you can determine or calculate every kind of parameter of the system. One of the downsides, though, is that Bitcoin notoriously doesn't scale. So the block size has been 1 megabyte forever. I'm not really sure. Yeah, I mean, the Lightning Network has been talked about as a layer 2 or a scaling solution, but
it requires 95% consensus, right, to have a hard fork on Bitcoin or something very high like that.
Yeah, to implement changes to the protocol. So it's kind of difficult to implement changes, but I mean, that's kind of by design so that even a majority attacker would need like the whole network to implement some kind of a change. So it's kind of a security feature, if you want to call it that. But so if you think of like Bitcoin as almost like the caveman of crypto, actually, hold on. So to go more into Bitcoin, so Bitcoin is kind of like it's a shared ledger, which is like a big list of transactions that anybody can look at. So the Bitcoin network actually relies on this ledger since it allows wallets to determine everyone's spendable balances. And so this function, this ledger, ensures that everybody can actually make the transactions that they're trying to execute. And a transaction on Bitcoin simply means sending some Bitcoins or a fraction of a Bitcoin to another wallet on the Bitcoin network. And so these transactions are a way to transfer value. And then these wallets that I mentioned earlier are kind of the vessels that give you access to these coins and ensure that only you can access these coins with a secret code called a private key or a seed phrase. And this is a phrase that should be kept secret and shared with absolutely nobody under any circumstances. So if somebody were to gain access to these keys, they could effectively take all Bitcoins associated with that key. So be sure to keep it safe. This key basically prevents unauthorized access from your. You're in sole control.
Sorry, David, you cut out there for a second, but you were talking about sort of the philosophy, not your keys, not your crypto.
Yeah.
The sort of the difference between like keeping your Bitcoin in an exchange's wallet. It's their seed phrase, it's their actual wallet. You're just kind of renting space there, so to speak, versus having your own Bitcoin wallet with your own seed phrase. It's completely in your control. Nobody can take that from you unless for whatever reason your seed phrase got revealed. So you're sort of tying what was going on, or what the purpose of Bitcoin was trying to accomplish, create like a decentralized money, and then how Ethereum built on top of what Bitcoin did, and sort of expanded upon the great work of Satoshi Nakamoto.
Yeah, so Ethereum took some of those concepts that I just described and basically wanted to add the ability to kind of program simple functions into how you could manipulate or interact with these currencies. And so these smart contracts allow things like DeFi to exist, or some of the games that are arising on Ethereum, but really a vast variety of applications, even like the NFT boom.
So could you talk specifically about Ethereum and smart contract capacity? Because that's something that Bitcoin doesn't have. It's not something that it will ever have. How did Ethereum accomplish this? How did they basically create a Bitcoin that allowed users to build projects on top of it?
So the key difference between Ethereum or Bitcoin and Ethereum's coding languages is that Ethereum is Turing complete, which means that which means that before you execute a script on Ethereum, you don't know if it will stop running. And so this is not possible on Bitcoin intentionally, so that before a script is executed on Bitcoin, you actually do know how long it will take to execute beforehand. So it's basically a security thing, because if I know when it will end, I basically know that it's a finite amount of time. So you could run a script on Ethereum and not know if it would stop running. So the idea is, like, if you get stuck in an endless loop, you basically break this machine. So that's kind of
That makes sense, David. Sorry, you cut out a little bit again. Wanted to just press on with Ethereum versus ADA. Ethereum being considered the second generation crypto, ADA being considered the third. How did the Cardano blockchain build upon the work that Ethereum did, and how did they improve it?
So Ethereum still uses the proof of work consensus mechanism that Bitcoin does, but essentially having to use resources external to a blockchain system can be perceived as like a value leak or value leaking from the system. So basically in Bitcoin or Ethereum, you mine your blocks, you get your reward, you take that reward, sell it for fiat, you take your fiat, you buy more mining equipment, plug it in, you turn on, you mine more blocks, and you repeat. So the leak in value is basically you have to sell your crypto, or you have to sell the thing you actually want to buy hardware that you don't necessarily like. You don't actually want the hardware, you want the block reward, but it forces you to buy things that you don't actually want to get the thing you want. So
and spend energy, like money on energy, and using that energy, which I mean, there's a million other things that are worse for the planet, but it does seem a little bit wasteful, the amount of energy that is spent on like ASIC mining, big factory mining. You know, how much more efficient, like ADA is compared to Bitcoin. I mean, how many stake pools are on Cardano? Maybe like 2,000, 3,000 at most. If you compare the energy use from those stake pools, versus the miners that are on Bitcoin, it's like night and day. ADA is incredibly more efficient. I don't know the exact figures, but I would guess that ADA probably, I mean, the entire network probably produces over or less than 1% of the energy or the amount of carbon that Bitcoin produces. So I think that there is a key difference when looking at Cardano versus Bitcoin, or Cardano versus Ethereum in terms of the energy needed to actually secure that blockchain's transactions and produce the blockchain. Do you agree with that, David?
Yeah.
So moving on from ADA, were there any other particular topics that you wanted to touch on now? I know, so one thing I wanted to ask you, kind of harping off of the conversation that we just had, do you think that Bitcoin will eventually die, considering the improvements that these other chains have made upon the original work? We sort of see Bitcoin supremacy waning, and Ethereum catching up very, very quickly to it. Do you think that Bitcoin itself will always have a place because it was the first, or do you think that people will eventually get off Bitcoin almost entirely and really be utilizing these other blockchains that are much improved from what Bitcoin initially launched?
No, I think Bitcoin it might always exist, but it won't be number one forever. If you look back to like the early internet, Google was the 21st search engine, I believe. So my point is, whatever is the Apple or Google of crypto in the future, it probably isn't the same as today. So,
right.
The Google of crypto, like the next, once crypto and kind of decentralized finance kind of realizes what it can do over the next 10 or 20 years is when you'll see. In 10 or 20 years, do I think Bitcoin will still be number one? Probably not.
It might grow from where it is, though. It might still grow just at a lesser rate than some of these other chains.
Yeah, for sure. Like if you think about it, it kind of took 20 years to realize what the internet could do. It could take just as long, or maybe, I don't know, it could take half as long or just as long as it took to realize what you could do with the internet, to realize some of the applications that you can do with crypto that don't even exist like right now. So we're hoping to evolve kind of with Cardano and with the rest of the crypto ecosystem. So stay tuned.
Speaking of which, we'll start to wrap things up here. Just bringing things back to the stake pool. We have some good news for delegators. David, would you like to talk about that a little bit?
What's the news?
Oh, the block. I think I might have actually spoiled it earlier, but we hit our second block. So anybody who's delegated to our stake pool is going to get their reward next epoch. As I believe right now, based on the amount of average active stake we have, we should be hitting about like 14 or 15 blocks a year. So hopefully we're already above that trend right now. Hopefully that can continue and our luck will continue being high. ADApools.org hasn't updated yet, but I think our luck is somewhere in the 300% range right now. So the pool is doing really solid. So looking forward to what the future brings with that. David, any last thoughts?
After we got the second block, I got a notification that maybe there was a third block immediately after, and I was like, is there a third block? But there wasn't a third block. So
that was weird. Yeah, we both looked at ADA pools. It said we had 3 lifetime blocks, and it didn't make any sense because we had just hit the second one. We thought that we got extremely lucky with the third one for a few minutes there, and then we checked again a few minutes later, and it corrected back down to two lifetime blocks. So, yeah. Well, anyways, David, thank you again for doing this. And thank you for everybody out there watching. Hit the like and subscribe button if you enjoy content like this, and I hope to see you next week.